with my next guest. Anil Rego is joining in. He's the founder and chief executive officer of Right Horizons. Thank you so much, Anil, for taking the time. Let's start by talking about this in a couple of different buckets, because an increase in interest rates affects borrowers, it affects those that are looking to earn interest as well. Let's start with the first group of individuals. What are the implications for those that have loans already, that are going to go out and look for loans? Obviously, things get costlier, but what is the implication in terms of the EMI? Does it increase the amount of money that you spend every month, or can you stretch your tenure? Which is preferable?
Yeah, definitely. You have two sides of the coin, and for people who are borrowing with home loans or auto loans, etc. I think the first thing they need to check is it a floating rate or a fixed rate, right? So if it's a fixed rate, then actually you don't have a problem. But I think most home loans, which is the larger segment, are all floating rate loans. So that's a point that you need to keep in mind. And with an increase in the interest rates, okay, definitely your EMIs also either go up, or you have an option of increasing the tenure. Okay, and as a default, I guess most banks will just keep the same EMI and the tenure will get increased. You can also, if you're comfortable financially and cash flows are good, you may say, okay, I'll go to the bank and say I'll increase my EMI and keep the tenure the same. Okay, so that's something that you can look at. How quickly does it impact? There's a reset cycle that banks have, and depending on that reset cycle, you will find that you get impacted with higher interest rates. If the reset cycle is say monthly, then you will almost get it in the next month. And if it is, let's say, a quarterly, then you have a little bit of time depending on what is the exact date that some of that reset happens. So yes, bad news for borrowers that you would end up having a higher EMI or a higher tenure depending on what you would like there. And yes, so that will have a bit of a negative impact on your personal finance.
Talk about what is preferable before we move to the next part, which is obviously fixed income investments. I want to talk very briefly about which is more preferable, because I think a lot of people will be contending with this. If not overnight, which is not going to take place, at least over the next few months, we have a lot of borrowers who could see their costs go up, their interest costs go up. And I think particularly from the perspective of home loan borrowers, this is a very important factor to bear in mind. So if it is a decision of between increasing your EMI per month and increasing the tenure of the loan, which should you choose? And does it matter as to what part you are in the repayment of the cycle, if you're at the midpoint, or if you're at the start, or if you're closing to the end of the cycle?
Yeah, so interest rates impact you much more if you're at the beginning of the cycle, right? In the early part of your loan, because your principal repayment is less, a lot of it is actually the interest that you are paying. Now, it would completely depend on your personal preferences as to whether you should take a longer tenure or you should increase your, EMIs. And I think I think a simple principle that you can follow is how comfortable am I, right? If my retirement is close by, right, I would not want to increase tenure. It's an example. So if there are any reasons for which I may not want to increase it. Second is, some of us may be emotionally, we don't want to have a very high loan, okay, for a longer period of time. So again, there you may want to keep it shorter. And the third is that you have constraints in your monthly outflows. Let's say high interest rate EMI that you're paying, and you cannot afford too much more. Then you have no choice but to say, okay, let me keep the EMIs where it is and increase the tenure. At a point like this, still, if you ask me financially, what is it a good idea? Which is better? Just from a financial standpoint, I think interest rates are still low. Right, they are lower than what we've seen in the past, and it's once it goes past 9%, then I would say yes, you can actually start seeing how do I start pulling back. But even at this point, if you are getting a tax benefit and you are paying say a 7.5%, I think it's still not too high, and you'll probably get a better return on your SIPs, etc. So you would keep your EMIs where they are and increase your tenure. But if you have other reasons, like I said, and some of them emotional, non-financial, okay, then you could possibly do the opposite.
Absolutely. In fact, I was also reading up on the reset clause for the various types of loans, Anil, and from what I can read, the reset clause for the benchmark linked loans, which is all of the new loans, is within 3 months. And for the MCLR, which is the previous regime, it's once every year for most loans. So that's something to bear in mind. Let's talk about real interest rates as well. I want to talk about the implications of higher inflation, because inflation is really the reason why the Reserve Bank of India increased the policy rates and made the decision that it did today. It's an attempt to reduce the impact of inflation. But I want you to explain, for the benefit of my viewer, how corrosive inflation is and what the implications of a negative interest rate or negative return is for their finances.
Yeah, definitely. We are at a clear point wherein your inflation was higher than, let's say, your interest rate of your bank FD. Okay, and what was the background for this? I think RBI was being conservative, wanting to not impact the economy. And even though globally there were a little bit of interest rate up moves, we went slower than what ordinarily one we have gone through. But now it's gone negative, and because inflation went higher than your interest rates, and yes, that's a time to sit up and say, I need to come back and see how I can address the situation and increase interest rates. Now, what happens in a negative interest rate situation, negative real interest rate situation, when your inflation is higher, okay, is that there's no incentive to save, right? Because I'd rather just leave it and not even put it in a bank, because okay, I'm not getting even better than inflation, right? So there's lesser incentives to save. The second part of it is, again, if RBI leaves it untouched, right, people again will not say save, they're probably going to spend it all, and if they spend it off, inflation gets even worse. So it's a fine balance that the RBI needs to step in, and also ensure that they increase interest rates so that people start saving rather than spending and further fuel inflation. It becomes then it comes to a difficult point when they have to take a really high and difficult decision. So I think that is something that you keep in mind. Now, how does it impact a person? Yes, inflation actually takes away money from your hand indirectly, right? Because you will be spending a lot more on your basic essentials. You'll be spending a lot more on even some of the consumer goods, etc. So what it does is it has an indirect impact on your ability to save and invest. And there are many expenses that you will not be able to reduce, which are your day-to-day consumables and for what you need for your living expenses, right? So that is something which has an impact. Yes, so it's a difficult one for the RBI. Always increasing in interest rates impacts businesses, it impacts the economy and the growth and stuff. But at the same time, if they don't, you have the overhang of inflation, and that can really create bigger problems in the future. So I think it's a good measured way of going about it. And so even though it's a bitter pill, I think one needs to sort of swallow it and see how, from your side, you can take care of it. Either as
Said it. I do want to talk about what you mentioned in terms of how one should plan their investments, because with interest rates going up, it's good from the perspective of the depositor, from the perspective of the saver, because hopefully this will mean that they are going to be able to beat inflation. Inflation, by the way, is currently trending at about 6%. So your fixed deposit at 5.8%, or in some cases even less, is not beating inflation. And that's how you have negative interest rates. But the point that I'm trying to make, Anil, is I want my viewers to understand what their strategy should be in the near term, near to medium term, because I'm talking about the next 6 months or 7 months, where my guest in the first segment of this program was talking about the potential for interest rates to go even higher. The repo rate could potentially hit 5.5% in his estimation by March of 2023. With that in mind, what should the fixed income strategy of an individual should be if they're looking at fixed deposits?
Yes, so the people on the other side are happy that interest rates are going up. Of course, if there are different investment options in terms of tenure that you may have within your fixed income as well. So that is something that you need to keep in mind, because increasing interest rates have an impact on a certain part, especially on long-term investments that you made. So if you've invested in either a long-term bond, or you've invested in a debt mutual fund which has long-term bonds underlying, right? Both of them are going to get impacted, because what happens is, if you have a bond at 100 rupees and interest rates actually go up, the next person, if you want to sell it, right, will not be willing to give 100 rupees. They'll say, you know what, I am able to get 0.5% more or 0.4% more. So I will give you less than 100 rupees so that I continue to get that current interest rate, right? So you will find long-term debt instruments actually have an impact. So what is it that you do at this point of time, both for fixed deposits as well as debt instruments? I think the broad view is that we will see this is one of the first of the many more to come, right? And that's a normal cycle that happens. And so you need to look at shorter term FDs if you're looking at fixed deposits, and if you're looking at debt instruments, then you look at either ultra short term. Liquid can be an option, but you just have to see what is the yield coming out there, or you can even use floating rate debt funds. Okay, so some of these are the ones that you can look at and take care of it. As you go forward, as interest rates keep going up, then you can slowly start moving to longer term. You also
Sorry to cut you off. I think we've covered most bases, and unfortunately, Anil, we're running out of time. And I wanted to actually talk to you about housing and the perspective behind housing. I was hoping to talk to you about whether an individual absolutely needs to buy a house, but I think we'll have to save that conversation for next time, because we're completely out of time on this conversation. Thank you so much for joining in and for giving us the perspective you did.